Stocks thinking ahead of the close today as concerns about higher for longer interest rates put a damper on investor spirits. New York Fed President John Williams may be easing some concerns, saying he expects inflation to start coming down again in the second half of the year. For more on the Fed's path moving forward, I want to welcome in now Bob Elliott, Unlimited co-founder, CEO, and CIO. Bob, it is great to see you. So why don't we start there, Bob? So, John Williams did make some headlines today. He did say inflation is still too high. Goes on to say, Bob, I don't feel any urgency or need. I don't feel any urgency or need that we have to make a decision now, he said. What do you make of those comments, Bob? What do you make of where the Fed goes from here?
Well, I think given all the noise of the commentary, people often think that the Fed is likely to be more active in terms of shifting its policy mix than the reality. Most central banks, when they've been on pause for an extended period of time and aren't seeing meaningful shifts in the macroeconomy, the way that the Fed is seeing now, inflation still a little too high, underlying growth still pretty good. The inclination is to pause and do nothing and gather more information. And I think that's basically what we've seen through the whole slew of these Fed speakers over the course of the last couple of days, where basically all of them are pointing to the fact that it probably makes sense to just wait and see. Some of them are hoping for lower inflation. Some of them are maybe concerned that it might be a little bit higher, but wait and see is the key theme across all of them. And that means that, a meaningful cut cycle is probably not going to happen this year.
It's so interesting, Bob, because, a lot of market participants have sort of come to that view, despite whatever Fed funds futures are pricing in at one moment or another. We talk day in and day out about, the market is moving on this piece of data that the Fed is watching or this Fed speak. But like a lot of people are talking to are saying it doesn't matter if they cut this year. Stocks are almost agnostic to the Fed at this point. Do you think so?
For a period of time, it looked like stocks are agnostic, particularly at the beginning of the year as rate cuts came out and stocks rallied. But the key reason why that happened was that we had a resetting of growth expectations in the economy from coming into the year of below 1% growth to now expectations are that growth in the second through fourth quarter is going to be something like 3%. Each quarter on an annualized basis. That's very, very strong growth. Unlikely that we're going to achieve growth at quite that pace through the end of the year, combined with the fact that the Fed not delivering those cuts is going to put pressure on the bond market, discount rates, which is also a drag on stocks. And so I think we've transitioned. Really, after the first quarter, we've really transitioned to a point where a lot of the market action in stocks is really being driven by the bond market. And we've seen that, for the last couple of months.